Welcome back to the Turnaround Boardroom. I am your host, Paul Masco. This podcast is focused on serving home service business owners doing between $3 million and $15 million in annual revenue. If that's you, you are in the right spot. All our conversations here are real, no fluff, straight to the point, digging into the numbers. And in this episode, it's going to be all about financial expertise. How do they actually evaluate risk, survival, valuation in the home service world? Again, nothing discussed here should be considered financial, legal, or tax advice for your specific situation. Every business is different, including yours. Today, we have with us Dillon Carraway. Dillon is a senior loan officer at Live Oak Bank. He joined Live Oak in 2017 and has been working with businesses in the trades since 2020. He has funded over $100 million of loans to help support the growth and transition of business owners in the trades. And in his free time, he enjoys playing golf and spending time with his family. So, Dillon, welcome to the show. In the interest of time, let's just get right into it. What do you do at Live Oak Bank on a daily basis for people in the trades?
Awesome. Well, Paul, first and foremost, thanks for having me on. I feel honored to be a reoccurring guest. I think this is my first time ever being a reoccurring guest on a podcast. So appreciate it, man. But my role kind of encompasses a lot of different things, everything from external business development, managing strategic partnerships, to working with individual business owners, talking through deal structure, putting budgets together, collecting applications, kind of guiding them through the process from start to finish on it's kind of what we look for in a deal. This is what we do. Package it up, get it ready for underwriting, see it through underwriting, credit approval, and loan closing. But get to travel a little bit, sometimes more than my wife would prefer. But all in all, man, Live Oak's a great company to work for. I've been here for almost 9 years now, and enjoy every day of it.
Awesome. Love it. And obviously, you guys continue to grow. I've kind of watched your journey over the last couple of years, and really just helping more people in the trade. So when do people usually reach out to you? What triggers a home service business owner or someone looking in the trades to reach out to you at Live Oak Bank saying, "Hey, I think I need access to some funding"?
It varies. Sometimes it's guys saying, "Yeah, I'm supposed to be closing on an acquisition in 3 weeks. Can we get the process started?" And other times, I'm talking to existing business owners, and they're trying to plan for succession, and they reach out and say, "Looking to exit my business in the next 5 years. This is kind of what I want to get out of my exit. You know, how do I structure that? Who can I sell to?" So it varies from folks looking to move very quickly versus a long thought out process of taking steps year by year to make sure that we're setting up a seller and a potential buyer for success. So I would say on the succession planning side, we do a lot in commercial real estate too. We do a lot more pre-qualification to help folks really get prepared. So if they want to buy a building, we pre-qualify their business and themselves for a certain amount, so they kind of know what budget to go out and look in the market for. Succession again can be 3 to 5 years down the road, and I would say for acquisitions, working capital, those are typically folks that are ready to go ahead and get access to funding.
And you guys are like the biggest SBA lender in the country, correct?
We are, yeah. Our bank in total closed over $6 billion in loans last year. Not all of that was SBA. I think SBA eclipsed $4 billion. Don't quote me on that. But our portfolio has been growing every year. We're a preferred lender with the SBA and take great pride in the program. I think it's a incredible program with flexible down payment options and loan benefits for existing business owners and first-time buyers.
Awesome. That's awesome. Kudos to you guys there. And if you guys are ever in Wilmington, North Carolina, check out Live Oak Bank's campus. It's not your normal bank campus. I used to work in the corporate world in banks. They've got a pretty cool thing going on there. So you kind of hit on three things that I want to dig into today. One is access to working capital. A lot of our listeners might not even know that's a thing.
Mhm.
And then succession planning, and then also lastly, somebody that's listening to this thinking they might want to grow through acquisition and learn more about how do they access SBA funding in order to do that. So let's I'm just going to kind of go down the line, and we'll get into the good, bad, and ugly of what it takes to get a deal done. So let's go to working capital. We had a chat before this podcast just to learn a little bit more, and you guys do a lot of working capital loans for home service business owners. Give our listeners a little bit of insight into what that means, and just the entire process there.
Yeah, would love to. I think we closed over 60 working capital lines of credits for folks in the trade last year. It's a very common product. If you think about it, not every contractor is going to go out and buy a $4 million building or a $3 million competitor every day. But a lot of contractors do need access to capital to grow their business. As we know, being or living in North Carolina, it's a very seasonal industry and business model. So keeping cash reserves is very important. So going and trying to source working capital funding that has good loan terms is very important. Unfortunately, I see kind of the bad side of the financing industry when folks come to us after they've taken out a short-term high-interest loan. Sometimes those are often 12 to 24-month terms. I've seen them as short as 6-month terms with the interest rates between 30 and 70%. And essentially, it kind of creates a snowball effect where you're really just paying interest. And at the end of that term, they'll try to refinance it and increase the amount, and it just kind of snowballs. So I always encourage folks, whether you're exploring working capital financing through Live Oak or through other channels, make sure you read the terms and conditions. Look through that loan agreement with a fine tooth comb. The SBA has a fantastic working capital product. It can be used for everything such as marketing expenses, advertising, hiring, training, website redesign, truck stocking and wrapping, cash reserves. So many different uses. And the amounts we typically see, I think the average amount's around 250K. We can go down to $10,000. We can go up to 500K, depending on cash flow coverage. And it's a relatively simple process compared to traditional SBA loans. Um, Last year, or the year, I think it was the year before, we launched a completely different division at the bank called Live Oak Express to specifically target that loan program for those smaller loans. I think a lot of banks have shied away from doing smaller dollar loans over the years. SBA kind of realized that and made the program a little bit easier for banks and for borrowers to apply and receive funding. We love supporting small businesses. We love supporting the 3 employee businesses just as much as we do the 30 or 300 employee businesses. So we shifted a massive amount of resources to create this Live Oak Express team, and to put it into perspective on how much we've seen in growth for that team. I think when they started, there was like 5 employees, and now they're probably up to 30. So a lot of interest in that program. I probably sent out 7 applications for working capital this week, and it's Wednesday. So unfortunately, not everybody gets approved, but it is something that we kind of work through on an individual basis. And if for some reason we can't approve a business owner due to cash flow coverage or debt service coverage specifically, we'll kind of paint the target and say, hey, go work with Paul and increase, this margin or this KPI, and this is kind of what we would look for. So we try to help paint the target for them. But really good loan product, 10-year term, 10-year amortization for existing business owners. Oftentimes we're doing 100% financing. We oftentimes don't have to take outside collateral or life insurance requirements, and start to finish the process really takes about 3 to 4 weeks.
Super cool. So we got that nailed down. So if we want to grow our business. We need working capital for whether it's inventory, stock and trucks, wraps, marketing, website redesign, all the things that sometimes are big ticket items that aren't, you know, we're not going to pay every day, but we need it to get to the next level. You all can make that happen in 3 to 4 weeks, up to, depending on the business, up to $500,000. So I want to come back to that in a little bit about approvals and all that. But before we do, let's look at the next reason a lot of people reach out to you is acquisition. So someone wants to buy a business. Since all of our listeners, I would assume almost all our listeners already own a home service business, we're going to go down that route instead of going the route of the entrepreneur through acquisition people. We're gonna assume that our listeners want to grow through acquisition. Give us kind of like the insight into what that looks like. Say we own a $5 million HVAC company and we want to go buy either a competitor or a plumbing company or electrical company to kind of bolt on to our existing operation. What does that look like from your end?
It's a great way to grow. I think a lot of business owners do a really good job scaling and getting to a certain level. And so you can grow organically through working capital and reinvestment back into your company, or you can grow through acquisition. And we've seen interest in acquisitions increase substantially over the last 5 to 6 years. I know that you've seen a lot of consolidation in the industry, and probably a lot of listeners, on this podcast. But it's a fantastic way to grow. The SBA has a expansion program where oftentimes we can use your equity out of the existing business to use as a co-borrower and collateral to go and acquire another business. And oftentimes we can do 100% financing if it's of similar size, same geographic region, and the same, industry classification. So, think about, how do you expand your customer database? Do you want to spend a bunch on marketing, which works really good for some folks, or do you want to buy a company that has a database of thousands of customers that maybe haven't been appropriately marketed to or followed up with? So there's so many benefits outside of that. I mean, oftentimes, you're going to get a bunch of really good employees. I think labor continues to be a challenge in this industry. So buying a company that has a good culture from a good previous owner, that has a lot of loyal, good employees, I think is one of the largest benefits. But there's also different levers you can pull if you're buying a company that historically maybe hasn't kept up with price increasing as their cost of equipment has increased. That could be increasing their cost of goods and dragging down their gross profit a little bit. So you can find these businesses and make little tweaks to really fine tune, improve profitability. So it's a great way to grow your business, expand your footprint, get additional employees, and really essentially double your customer database overnight.
And what's the limit on that? I know you said, through the express, we can go up to 500,000. And now if we want to go through acquisition, if we're in the same industry, same geographic area, similar size, all that, we can get up to 100% funding. What's the max that we could borrow there?
So SBA typically allows 5 million for any given borrower. If we really like the deal and believe in it, and it's a good opportunity, we're willing to layer on $2.5 million of conventional debt on top of that. So think 7.5 million is probably what we're going to cap out at. But I work a lot of deals where they're like, "Hey, we want to buy this for $10 million. We can get comfortable again in certain scenarios funding up to 7.5." And then we can get creative on deal structure where maybe the remainder of that purchase is shifted over to a seller note. So there's ways we can get creative to really finance deals above and beyond 7.5 million. And that's where, kind of the area of expertise comes in because we've seen and done a ton of these transactions.
Awesome. That's super helpful. So last thing that we kind of talked about at the top before we get into kind of a little bit more of the weeds is succession planning. So we know how we can, leverage working capital to grow our business. We know how we can leverage, SBA funding to grow through acquisition. And then what does it look like from a succession planning standpoint? I'm 60 years old. I want to start, removing myself from this business and be out of here within the next 3 to 5 years. How do you guys help people in those situations?
Starts out with really a few questions. I ask owners, what are their goals that are thinking about exiting? First question is, are you truly ready to exit? It's a very emotional decision after you've been running your company for 30 years, getting in office at 6 a.m. and leaving at 5 p.m. every day. So you really got to decide if you're truly ready to exit. Second, we'll talk about potential new owners, so who they plan to transition the business to. Oftentimes, we see that's family members or maybe a key employee. Internal buyouts are one of our favorite deals to do. Typically, that's a office manager or lead operations manager, service tech, general manager. They're familiar with the business, the customers, the suppliers. And how that business generates revenue and profit. So we love internal buyouts, and oftentimes, we see other local competitors that are locally owned as a great option um, to transition the business to. I think sellers really care about their employees, and rightfully so. Their employees are oftentimes have been with them for many years. They've seen ups and downs in the business and in the industry and helped them get through tough times. So they want to make sure their folks are taken care of. I think a lot of sellers fear that if they sell to the wrong buyer, that their employees will either have their salaries cut or their positions eliminated. So really, to kind of summarize, are you truly ready to exit? What does life look like after you sell your business? Do you want to be involved? Because the SBA will only allow you to stay up to 12 months in the business post close. Then two, try to identify a potential buyer. And then three, trying to identify what you want to sell the business for. I'm not a CPA or a financial planner by trade. So I always say consult with your CPA, your financial planner, figure out what tax burden you're going to have. But often the exercise I do is saying, okay, Paul, you want to sell your business for $5 million. Let me take a look at the financials. Let me take a look at some reasonable personal expenses that you've ran through the business that would be non-reoccurring after you exit, and run a cash flow analysis to see what we could potentially finance for a new buyer. And sometimes that's a harsh reality for business owners because they think their business is worth 5 million, and on paper, when we do our cash flow analysis, the cash flow can only support a $3 million loan. So that leaves a pretty big gap. So I'll say, hey, if you truly want to sell your business for 5 million, through my cash flow analysis, we can only fund 3 million at this time. But if you get to this level, a cash flow, the projected cash flow could support this level of debt. So that's another good exercise that we run through.
Awesome. Super helpful. So let's get into that. So someone comes to you, they're looking for funding, whether it's they need working capital or they want to grow through acquisition. What is the first thing that you guys look at when those people come to you?
Typically, we'll review business financials. I want to make sure that that makes sense from a cash flow perspective before I have customers start filling out a bunch of personal documents. The numbers have to make sense before we do the deal. But we kind of look at personal side, business side. On the personal side, we'll look at FICOs, so personal credit scores for yourself and your spouse if you're married. We'll take a look at what type of personal debt that you have, because we like to think if you can't manage your personal financials responsibly, then that's probably going to translate into poor decisions within the business financially. So we take a look at that. We take a look at a financial statement, see what kind of liquidity you have. Do you have any equity in any real estate? While it's not required for SBA loans, it's often considered if you do have it. So that is something we review and communicate with our customers. And then industry experience. I know that to this audience, a lot of those folks are going to check the box, but if you're an HVAC owner and you're buying an electrical business, are there any specific licensing requirements we need to consider? Because we want to make sure the business can operate and generate revenue legally. So always thinking about licensing. And then on the business side, we look at historical trends, KPIs. Think high level revenue, gross profit, net profit, and SDE, seller's discretionary earnings, is typically what we review, and that can encompass a few different things. We're pretty comfortable with some add backs, so to speak. Think if you're a seller and you're running, your personal or your family's health insurance or vehicle payments, cell phone payments, things of that nature. Obviously the W-2 salary that you were paying yourself, or if you were paying any family members that were not working in the business, those are common add backs. If they're trying to report a bunch of cash jobs that they did the previous year that they didn't report on their taxes, that's a no-go for us. So you can't have your cake there and eat it too. But yeah, just I think we use common sense when we're trying to determine what the true seller's discretionary earnings is of that business. Um, Outside of that, we look at trends. Oftentimes, you'll see when business owners are ready to sell, it's hockey stick growth. So we want to find out what revenue and profitability is sustainable. I think there's always a story to revenue and profitability increases and decreases, and understanding that is super important. But we do like to see stable financials. We look at work mix. We tend to favor service repair, retrofit, change out, tenant improvement type business models. Um, you know, we also want to stay away from businesses that are heavily involved with new construction installation, just because that revenue is not as sticky and reoccurring. Sometimes the margins aren't as good. They typically will carry higher accounts receivable balances, which can lead to cash flow cycles that are not favorable. So think work mix is really important. Customer concentration. We want to make sure that all your revenue isn't coming from one source or two sources. Um, I think that's a pretty good description of
I
kind
think
of
you
what we
covered a
look
lot
at.
of it. Yeah. So one of the things you mentioned several times is the cash flow analysis that you guys run. What is like kind of a healthy, debt service coverage ratio that you guys are looking for? Just so our listeners can kind of get a better idea of, what can a business actually, you know, what kind of ability do they have to cover their debt without being super stressed about it?
Yeah, we really like 1.5 debt service coverage. However, our minimum is 1.25, so we can go down to that. But essentially, that's $1.50 of free cash flow to cover every dollar of debt. And we also factor in what the business owner needs to support their personal lifestyle. We call that required officer's compensation. So we never want to make a loan to a business that can't uh, cover the payments from a historical financial performance basis. Because if we make a loan to you, Paul, for your HVAC business, we're probably very undersecured from a collateral perspective. So if you default on the loan, throw in the towel, and give us the keys, we don't have anything to liquidate. So, it's a lose lose scenario for both of us. And we understand that there's real people on the other sides of these transactions. So, I'm never going to push a deal through just for a production perspective. We take our credit health metrics very seriously at Live Oak. So, we want to make good loans and good credit decisions, things of that nature.
Perfect. One of the other things you mentioned is licensing, and I know the SBA is always changing these things. It feels like every 6 months, but let's use the example that you had mentioned. I own an HVAC company. I want to buy an electrical company. I don't have an electrical license. What does the SBA, at least right now, we're recording this February 2026, what do they allow currently to be put in place to make sure when we, like you said, buy that business, we can continue to provide electrical service legally?
I think it varies deal by deal. And like you said, it can change over time what different lenders kind of look for in licensing. We've kind of stuck to our guns despite SBA changes on kind of what we want to see in licensing, since we specialize in the industry. First and foremost, we would love for whoever is signing off on our loan as a guarantor, the operator of the business, to be the license holder. But we realize that's not attainable in every situation. So if we can't, achieve that, then sometimes we'll look for key employees within that business that may provide the licensing for the business already. I know there's a lot of business owners in the trades that have never had a license to qualify their business. So if we can identify, a license holder within the business you're looking to purchase, oftentimes what's really favorable is offering them some minority equity, maybe 5% in the new ownership structure. That gives upside to the individual. That will be, a key part of licensing the business and continuing revenue generation. And then, I think it's always important to identify a secondary license holder. Unfortunately, not everybody's promised tomorrow. So if something were to happen to your primary license holder, what's the backup plan? So we try to think of all these things, and again, every scenario is different. Paul, maybe you did some electrical work, back when you were in high school, or you have some sort of degree that could bypass some prerequisites for you to sit down and take the licensing exam, and maybe you can do that in 3 months versus your traditional 4-year time period. So we could potentially provide flexibility there. Every situation is different, so it's hard to say this is exactly what we look for, but we typically look for owners to be the license holders, whether they're minority or a majority.
Makes perfect sense. And then lastly, one of the other things you said that you guys kind of, you know, dig into, and I know this, in the work I do, I see this often, but new construction, how much work, how much revenue is made up of new construction. A lot of times it's all relationship based. Once that current owner's out, the GC is going to then reshop it out because they don't have that relationship anymore. What's acceptable, roughly? Obviously, like you said, every deal is different, but what's kind of the acceptable range that you guys are okay with of as far as a percentage of revenue that goes to new construction?
Yeah, I think standard 35% is typically what we look for. We understand that a lot of contractors have relationships with a few custom home builders, and they'll take one-off jobs in the shoulder season to keep their guys busy and keep revenue coming in the door, and that's something we're perfectly okay with. But if your main revenue source is installing units on track homes from neighborhood to neighborhood, it's probably not a good fit for us. But I would say 35%.
Super helpful. So we'll kind of move along in the process now and just, want to get a little bit more insight as these deals go along. So say everyone, initial team, everything looks okay. Let's send this to underwriting. When it goes to underwriting, what are some of the things, common themes that underwriting comes back and says, no, we can only give them this amount, not this amount? What are some things that, are kind of commonplace in the underwriting world?
So I would say our lenders at Live Oak take a lot of pride in having tough conversations up front. Essentially, we want to make sure there's no surprises once a proposal letter is signed. So if there is hair on a deal, so to speak, something may be, teetering on the border, we'll go ahead and schedule a meeting with our credit team as a lending officer to say, hey, this is kind of what we're seeing on this deal. Is this something we can get comfortable with? What feedback can we give to our borrower to maybe get comfortable? If it's a no, it's a no, and we want to communicate that as transparently and as quick as we can, because everybody's time is valuable. And if it's a no for us, another bank might take a look. So we want to be respectful of everybody's time. But I would say once loans get into underwriting, we have everything pretty buttoned up. We have a good narrative of the business, licensing plan, add back summary, transition plan, all that. So not a ton will come up in underwriting. To be honest, I know that may sound a little surprising, but they're more so just combing through everything that we've collected this far, kind of putting a narrative together for our credit team, building out a really nice file, adding a lot of comments about different aspects of the deal. But there's no like major red flags that are typically uncovered in underwriting.
It's awesome that y'all, if you're needing access to funding, Live Oak Bank, they got to go on. Reach out to Dillon. But as we kind of go along in this conversation, some people might be thinking, I, I want to grow through acquisition. And you had brought up an example 20 minutes ago saying someone comes to you like, hey, we need to close on this in 3 weeks. And now we just need the funding. We talked about the, Live Oak Express. We can get, working capital 2, 3, 4 weeks. But when it comes to buying a business, what are realistic expectations, from a range standpoint of
Mhm.
they reach out to Live Oak today? When will they be able to close on that deal?
Yeah, I always like to underpromise and overdeliver. I'm not going to tell you we can do something and not be able to execute on that. Uh, and oddly enough, a lot of the timeline will be out of our control for uh, the timeline of the total process. I would say standard, once we have a full application, you're probably looking 6 to 8 weeks. But if we get into the closing process and buyer's attorney and seller's attorney can't agree on two sentences in a purchase agreement and keep going back and forth, or attorneys go on vacation, which always seems to happen, coincidentally enough, um, then that can drag out the process by a few weeks. But we try to move as quick as we can to hit borrowers' timelines. But I would say on average 6 to 8 weeks from full application in hand, getting into underwriting.
And you had kind of alluded to, things that can hang up deals. In your experience, you've been doing this a while now. What are some of the most common, call it deal killers, that you see throughout this process, that our listeners could, put on their horizon if they ever do need to go through this process? What are some things that they need to look out from a deal killer standpoint?
Really, if there's a required equity injection, making sure they have those ducks in a row, making sure personal credit looks good, um, it, doing their own due diligence on the business they're wanting to buy is super important. Believe it or not, I'll have folks send me like 7 different businesses and say, "Tell me which one to buy." And unfortunately, the process doesn't work like that. Paul, if you're interested in buying a business, I want to know why you want to buy it. What do you like about the business? Tell me about the transition plan. So, borrowers doing their own homework is super important for us and telling us why they like the business and the opportunity. Customer concentration, all those things that we've discussed are typically things that we'll cover in our initial call. So we try to be as productive as we can on the initial call to kind of go through all that before we even send out one document. Because again, we want to be respectful of everybody's time and we want to move as quickly as we can. Um, so yeah, I don't think there's anything that could be immediate deal killers like once we have a full application in file.
Gotcha. So let's fast forward. We have now bought a business.
Hmm.
We have acquired a business. What, where do you see? Because obviously, right, everyone's got to mitigate their risk as much as possible. You guys do you guys do all your due diligence. Buyer does all their due diligence. But sometimes once the buyer takes over, the business just wasn't what they thought it would be, or they all of a sudden they're struggling paying their debt because X, Y, and Z happened. What are some again, it doesn't happen often, but when it does, it's not great for anybody involved. What are some things that you've seen over the years that, make it hard for someone who has acquired a business to then continue to make their debt service?
I think, and this sounds really simple, but it's what I've learned over the years. It's really important to trust your gut. If something doesn't feel right, it's probably not right. I think one of the most important things is not obviously cash flow, debt service coverage, all that has to work. But outside of the numbers, buying a business from a seller that's going to act in good faith, that has not misrepresented the business, is super important. A lot of times brokers list businesses, and there's a lot of fantastic brokers that do a really good job. And, sometimes they might not even be aware, but, say, for example, you buy a company and you realize day one, you go in, seller doesn't introduce you. They've already, moved to Florida to start playing golf every day. So you're there trying to introduce yourself and you have the whole staff walk out on you and you don't know if they're going to be back tomorrow. I mean, that's a pretty stressful situation. So really kind of knowing what you're getting into, trusting your gut, kind of doing your financial due diligence as well as, having the bank do it, I think is really important.
Yeah. So on that note, what do you see most commonly? Because I know it's kind of a gray area and everyone's got an opinion. So I'm curious of what you see works best. But as far as introducing that new buyer, when do they do it? Right? Some people say don't say a word until this business is sold, and then you show up the next day and everyone's like caught off guard, and then sometimes it can be a little hectic. Versus I've seen plenty of deals where the buyer comes in 2 or 3 months before closing and like really becomes part of the business, and it's fully transparent based on how the relationship the seller has with all of their team. So just curious of what you've seen, through deals as far as seller introducing the buyer. When do they do it? How do they do it? What have you found works best?
Again, you're probably tired of hearing this, but every deal is different. Every transaction's different. I will say more than not, we see sellers do the buyer new owner introduction post close, typically day one of following closing. But I have seen a lot of scenarios where sellers will bring in new buyers to kind of introduce to key personnel once they get in the closing stage, which I think is awesome. But every deal's different. Every situation's different. Um, I think as long as the buyer shares a like-minded vision and similar culture that the seller had, and treats everybody with respect, and values their opinion and their input, I think pre or post close, really might not matter.
We've gone through a lot, Dylan. Appreciate all of the insight. Hopefully, our listeners got a ton out of this as well. Before we wrap up, though, what did we miss? What's something that you feel everyone needs to hear that we haven't dug in today? Give us something good.
I think we've covered a lot. I think I would encourage folks to just never hesitate to reach out, whether you're looking to work on a loan transaction in 2 weeks or 10 years. Knowledge is power. Establishing relationships and connections is super important. So it all starts with an email or a phone call. I'm always happy to schedule some time, kind of hear what your goals are as a business owner, and see if we have a way to help you achieve those goals. I would say that's kind of my one piece of advice.
Yeah, I think that's great advice. Even thinking it through like the working capital, everyone says, go get lines of credit and get access to capital when you don't need it, because when you do need it, it's nice to already have it and not have to go through that process, and just makes it a lot
Exactly.
easier. But Dylan is super available. You can reach out to him at any time. We'll put it in the show notes as well. But Dylan, what's the best place if anyone's interested in having a conversation with you? Where's the best place for them to go?
Cell phone. I'm sure you can post my cell number in the show notes, or on your website. I'm not sure how you do it, but cell phone is the best way to do it. Call, text, email. Feel free to share my email address as well. But I'm available by my cell phone. Pretty much 24/7.
And I can attest to that. If I text Dylan, he will reply, and his family is growing though, so his reply time might go down as time goes on.
Yeah,
But
after
Dylan,
after June, maybe a little tough for a few weeks.
yeah, depending on when you guys are listening to this, but reach out to Dylan. We'll put his phone number in the show notes as well, because whatever you're doing right now, you're probably not just sitting down there with a pen and paper. But Dylan, really appreciate you coming to the show today, sharing a ton of good just insight into what goes on when it comes to getting access to capital. Guys, this is how professionals on the financial side of the trades really look at things. They're going to look at the numbers. They're going to look at all the things. Like you said, you can't have your cake and eat it too. So no matter what you're looking to do, get your financial side in order, so that way when it is time to make a move, whether it's to buy, to sell, access to capital, y'all are ready. And then lastly, if this episode did resonate with you and you are ready to get your business financially healthy, go to thebluecollaradvisors.com. When you're there as well, you can check out the show notes, get access to Dylan's cell phone number as well. But Dylan, thank you again for coming to the show today. Really appreciate it.
Yeah, thanks, Paul. Blast as always, man.